Welcome to Open Sky Policy Institute webinar today. Sorry, I thought we were going to have another minute of some of that lovely music while people were coming on in the slideshow. But thank you all so much for joining us today. My name is Renee Fry. I'm the Executive Director of Open Sky Policy Institute. So again, welcome to our webinar this morning. We are very fortunate to have UNL tax law professor Adam Thimmesch to discuss the tax changes in the CARES Act and the potential impact on state revenue. Professor Thimmesch, I think you can share your video whenever you're ready. Thank you so much for being here today, Professor Thimmesch. Some of you likely recognize Professor Thimmesch as he has shared his experience or his expertise with us a couple of times over the last few years. For those of you who are not familiar with Open Sky Policy Institute, we're a nonpartisan nonprofit focused on budget, tax policy, and education finance. I do want to take a minute to thank the rest of the Open Sky team for their help with this webinar. And you see Chuck Brown is managing things behind the scene, where you can see Open Sky Policy Institute, and then Alex Serrier is our White's Fellow, and he's going to be helping us manage questions today. Most of you probably know that when Congress passed the Coronavirus Aid, Relief and Economic Security Act, also known as the CARES Act at the end of March, it amended several provisions in the federal tax code because Nebraska is a state of rolling conformity to the federal tax code, meaning our tax code is coupled to the federal tax code. Federal tax changes can automatically affect our state tax receipts. At the end of May, the Nebraska Department of Revenue issued a report outlining the various tax changes and the state revenue implications of those changes. The Department of Revenue estimates a revenue reduction of $250 million over the next 3 years if Nebraska doesn't decouple from those provisions. Specifically, $125 million in FY21, $68 million in FY22, and $57 million in FY23. In mid-June, the department held a briefing for the Revenue Committee to better understand the tax provisions that would be impacted, and the legislature will need to decide if they want to let the tax cuts take effect, which would add to the revenue loss the state is experiencing due to COVID-19, or if the legislature wants to preserve that revenue for other purposes, such as funding for education or property tax relief. Because these are complicated issues, we've asked Professor Thimmesch to provide a pretty high-level overview of the tax changes to help inform the discussion around how the legislature might think about proceeding on this issue. So just a few housekeeping issues before we get started. This webinar is being recorded, and that recording will be available following the webinar. Professor Thimmesch's PowerPoint presentation will also be available. And attendees will be on mute for the entire duration of this webinar. If you have a question, please type it in the Q&A box at the bottom of your screen at any time. However, please limit yourself to no more than 2 questions. That will be much easier for us to manage and will give more people an opportunity to ask questions. We've already received some questions in advance, but we'll do our best to make sure we answer as many questions as possible. So to get started, Professor Thimmesch, could we start by just having you tell us a little bit about yourself, your expertise, and your experience?
Yeah, I shy away from the word expertise, but that's good old Midwestern modesty, I guess. So hi, everyone, if I haven't had a chance to meet you or speak with you before. So I'm at the College of Law, where I've been since 2012. Before that, I was a practicing lawyer up in the Twin Cities for about 7 years, doing a lot of work on business transactions, but state and local taxation, multi-state taxation on the industry side. So since I've been at the law college, my area of research and focus has been on multi-state taxation and on the relationship between states and the federal government, this broader field of fiscal federalism and how we allocate taxing power and how states can best structure their systems within the constraints put out by Congress and by the Supreme Court. So this sort of topic is right in the wheelhouse of the things that I've been thinking about and writing about. I know that Renee, your team put out on blog posting some links. I've done some just general writings on this topic, general for states across the board in thinking about conformity and thinking about their tax bases, especially in times like the pandemic, in times of real fiscal distress. The state role in understanding the tools that states have available to them as compared to the federal government is something that there's been a lot of research on, most recently the Great Recession. And so that's the type of thing that I've been involved with and do a lot of thinking on and publishing on. So I'm excited to be able to put that into play in Nebraska and think about how Nebraska can utilize the broader thinking and lessons on this topic. So that do it for the background and sort of my area and where.
Yeah, that's perfect. Well, thanks again for being here today, and we'll go ahead and have you get started with your presentation.
Great. Let me see if I can successfully share my presentation here. I've screwed this up from time to time teaching online, so I'll look for a thumbs up, but it looks like Renee isn't telling me that I've screwed something up yet. So, so what I want to do is, as Renee said, provide a higher level overview. There's obviously a lot at play here, and I want to touch on the different aspects of this issue, get into the weeds a little bit, but really make sure that we get a complete picture, and then save significant time for Q&A so that we can answer questions that you specifically have. But really want to make sure that everyone's kind of on the same playing field here and understand the broader picture. So as Renee said, we start with the CARES Act. We've got a federal bill that was enacted March 27th, responding to the COVID-19 pandemic. And really bigger picture, when we think about Nebraska and Nebraska's response and whether we should decouple or conform, which we'll talk about, it's useful to put that in the context of the broader federal response to this public health crisis and the economic problems that it has created. So the CARES Act contains the tax changes that we will talk about, but that's really a small part of the federal response. So the CARES Act provided a number of different provisions and programs directed at taxpayers directly, businesses and individuals, and state and local governments. So that includes the Paycheck Protection Program, that PPP program. It includes the EIP, those direct stimulus payments to individuals. It includes a whole host of grants to businesses and state and local governments. And then it also includes some tax changes to the federal tax code. So how have these impacted Nebraska? Probably some general familiarity with this, but I think it's useful to put some numbers to it to get an idea of the perspective of what we're talking about. So I think the number is right around $8 billion in total federal funds have come into Nebraska thus far under the CARES Act. About $3.4 billion of that is that PPP, those forgivable loans directly to Nebraska businesses in need. If you followed the press on this, we've received quite a bit of national press on how successful Nebraska businesses and their banks were and the relationships between them. So $3.4 billion to Nebraska businesses directly from the federal government in this way. We've got about $1.6 billion in those EIP payments directly to Nebraska residents, those stimulus payments in bank accounts and in those cards. And then we've got over $1 billion, and here the numbers kind of vary depending on what you group into it. I think it's about 1.25 billion, something like that, in grants to help cities, counties, and businesses in need. That includes about $400 million for agriculture and other business relief, and of that, I think $230 million for small business stabilization. I'm not an expert on the grant side of things. I'm a tax person. I think about the tax structural part, but it's hard to analyze the tax aspects of this, especially if you think of tax as stimulus funding or tax breaks as stimulus funding, without looking at these other available dollars and the congressional response to the pandemic. So that's a lot of money, right? So that's direct federal grants to Nebraskans and Nebraska businesses in need. On top of those, then we also got those federal tax cuts to certain taxpayers. So the tax cuts are what we're going to talk about a little bit more specifically, what those are, how they actually work out, a little bit of the nuance of those. But it's important, I think, on this slide to recognize that the tax cuts are really a small part of that stimulus-based funding. Now, the reality, though, and what Renee led in with, is that those federal tax cuts, given how our law is structured, directly translate into Nebraska tax cuts. So Nebraska, like every other state with an income tax, piggybacks or delegates up or conforms to the federal tax code. The federal tax law, as you probably know, is very robust. There are a lot of regulations. There's a robust administrative and enforcement mechanism behind it. And so all states with an income tax just piggyback in one way or another to that federal tax code for purposes of their own laws. Nebraska does that on what's called a rolling basis, as Renee said, which means we automatically conform to any changes to the federal tax code. Now, we piggyback at adjusted gross income, and so there are some changes we don't conform to, lower down tax credits, things of that nature. But major top-level changes to the federal tax code automatically get incorporated into Nebraska law because we are that rolling conformity state. It's about a 50-50 split among states if you're thinking about this issue. 50% of the states that conform do so on a rolling basis. They effectively delegate their tax writing to Congress. Any change made by Congress becomes state law unless they affirmatively opt out. The other half do something called static or fixed conformity, where they conform as of a particular date. So they will say our tax law is the same as the federal government's as of January 1, 2019 or 2020. And then the legislature has to come forward and update that date. What we see in those states is that those states are generally a little bit more active in decoupling, right? The requirement that they come together and actually advance the date, we see that they actually say no to federal changes a little bit more often. So Nebraska's in this rolling situation, right? We've delegated our tax writing authority to Congress. The legislature said, we don't want to handle it. Let's let Congress write the tax laws. We will come back and affirmatively opt out if we don't like anything. And states do that for a wide variety of reasons. People are generally familiar. Congress uses the federal tax code for a ton of reasons other than fiscal policy. There's social policy, there's economic policy. And so states very often say that federal policy choice doesn't reflect local preference, or that federal policy choice is one we can't afford to support. And so for a wide variety of reasons, states will affirmatively opt out of federal law from time to time. Now, in the context of the CARES Act, the Department of Revenue has estimated, and this is what Renee led with, that conformity with the CARES Act, right, this delegation of authority to Congress, is going to cost Nebraska about $250 million of tax revenue over the next 3 years. So that is our default position. That is the position we have been put in. And so the question that the legislature has to face is, should Nebraska conform to that, right? Should Nebraska give $250 million of income tax cuts in the midst of the pandemic? Stated another way, I think, and when you think about this issue structurally, and those who work in the field think about this issue differently, which is, would the Nebraska legislature have come forward and proposed these tax cuts? Right? They obviously didn't do so in the regular session. So in this special session, would the legislature come forward and say, the pandemic has happened, we need to provide stimulus funding, and so here is a package of income tax cuts that we think is right? So that's fundamentally the question, however you frame it, is if the legislature does nothing, it is as if they have enacted this $250 million income tax package. So then the question is, should they do that or not? That gets a little bit outside my area of expertise, but I can frame the question. It is very clear, and we've seen responses to this effect, if you give people tax cuts, it helps them. There's absolutely no doubt about that, right? A dollar back in an individual's or a business's pocket helps that individual, helps that business, at least in the short term, right? And many of the people who would receive these tax cuts undoubtedly impacted by the pandemic. No question there. Can't debate or doubt that, right? The effects of this pandemic have been widespread. Almost everybody, if not everybody, has been impacted negatively financially in some way. So those are undoubtedly upsides of conforming to the federal tax code or of not decoupling. The individuals who are chosen by Congress to receive this cut will absolutely benefit. The trick at a state level, though, is that states don't operate like the federal government. as we're probably all aware, the federal government tends to do these things by borrowing, right? And that's a major distinction when we think about federal tax policy and state tax policy, especially in the context of deep recessions like the Great Recession or something like the pandemic, these big external shocks. States don't have the borrowing capacity that the federal government has to provide stimulus-based funding in these times of distress. So in the world of fiscal federalism, or in people who think about this structurally, we look to the federal government to provide these funds because of the federal government's borrowing capacity and its ability to just generally handle these things. What it means at a state level, though, is that there are trade-offs. If you operate under a balanced budget requirement, right, you don't have the ability to just print money to go into debt, it's a trade-off. So you have to ask yourself, right, if the policy question is, should we give these cuts? If somebody says, well, we should because group A would benefit, necessarily the question at a state level is, who is group B who is going to bear the burden, right? Are we going to cut something to fund the payment over here, right? Are we going to cut spending? Are we going to push off a tax cut? What are we going to do? Or whose taxes are we going to raise? And that's just a fundamental disconnect between federal tax policy and state tax policy. Federal government gets to kick the can down the road, incur debt, say that people in the future will pay it. States have to make the trade-off. So when we think about this big question, should Nebraska decouple or should Nebraska conform? Part one is admitting, yeah, the people who get the tax cuts will benefit. But part two has to be, who is going to carry the water for that tax cut? How are we going to fund that $250 million shortfall? And if we're going to do it, why, right? Why are we wanting to do this? The major rationale given, and what I've seen in the press and what we've offered here, is that it's stimulus, right? We want to reallocate this money. We want to conform and give this $250 million tax cut, whatever it is, because it's stimulus funding. These businesses are in need. They could use the cash. This is a way of getting them cash. The federal government did it. We should do it too. The question you have to address, if you accept that, is if you want to provide stimulus funding to businesses in need, is this package the way that you would do it? And so transitioning to that question conveniently transitions me into talking about the CARES Act provisions. But I wanted to set this up because you can't think about the tax aspects in isolation. As much as I love tax and I love these issues, the world is not all about tax, right? It's in the broader context that we have to think about these tax provisions. And the question is, do these tax provisions do what you want them to do? If you want to enact them to provide stimulus funding to businesses in need, do these achieve that goal? So with that said, I'll take the remaining time here to overview generally some of these provisions, generally high level, because otherwise we'd be here all month, which would work for me as a tax guy, but I presume nobody else wants to sit on this and talk about the intricacies of tax all day. So I'll provide a high level overview of the individual income tax changes in the CARES Act, then the corporate income tax changes, take a little bit of a look at what some other states have done, offer what I've recommended more generally in my writing, and then move on to questions. So CARES Act tax changes in the individual income tax realm. Department of Revenue has put out a really good publication on this as well. If you haven't seen it, they go through these provisions and explain them. Highly recommend that. Whole host of provisions here you can see on the slide. So there's some changes to the charitable contribution deduction. They added a $300 charitable contribution deduction that basically anybody can take now. If you recall back to the Tax Cuts and Jobs Act, Congress doubled the standard deduction, which effectively eliminated that charitable contribution deduction for 90% of taxpayers. So they added a new one in there that more people could take in response to the pandemic, right? You can see that there's a greater need to incentivize charitable contributions. Some increased deduction allowance on that as well for those who itemize. There's an exclusion for certain loan payments made by employers. So normally that would be gross income to an employee if your employer is just paying your debt for you. A little bit of a relief here. A few different rules for retirement funds. So some retirement fund distribution rules where we're going to change the rules up there. We're going to maybe allow some loans to retirement funds that we wouldn't otherwise have allowed. Temporary waiver of the required minimum distribution rules. So we want to allow people to not take those required minimum distributions if they want to keep their money in their accounts as the economy recovers. That has a tax impact, right? Because people aren't withdrawing that money, which reduces receipts. And then we get two really big ones and really kind of taxi tax ones, as my kids call it. So there are modified net operating loss rules, both in the individual income tax context and in the corporate tax context. These get a little bit more technical. If you're not familiar with the tax side of things, what net operating losses are effectively losses that you have for your business in a year that exceed your income, right? So maybe you've earned $100,000 and you've lost $300,000 or something like that. That excess loss is a net operating loss. And the tax code doesn't say, well, that just goes away. You're allowed to use it against income in other years. We recognize that income is earned and lost over time. We have to report it on a calendar year, but overall, if you lose 100 in year one and you gain 100 in year two, on net, you've broken even. So these net operating loss rules allow you to kind of travel with those losses through time and smooth out your income for tax purposes. So the Tax Cuts and Jobs Act made some changes to the net operating loss rules. It put a limit on those, said you could only deduct up to 80% of your income in a year with those net operating losses. It said you can only carry those forward and eliminate like this carry back provision. CARES Act changed that a little bit. It made allowed individuals to go back a couple of years and actually use those net operating losses. So it did free up some cash for taxpayers, if you will, but it applies to losses beyond 2020 losses, right? It is not aimed at pandemic losses. It actually will apply retroactively to losses that were incurred in prior years, regardless of how you're doing this year. So there are those rules. And then there was, what you'll see is really the biggie in the individual income tax context, what's called the excess business loss provision. So I'll talk about the nuance of that a little bit more here, because as you will see on the numbers, that's a really big one. Effectively, the excess business loss provision was a new provision enacted in the Tax Cuts and Jobs Act. It served to limit the losses that certain people could take from business activity against their other types of income. So we see this all across the tax code, where we try to put income and losses in buckets. And you can use losses in this bucket against income in this bucket, but we don't want you losing your losses from activity A to offset income elsewhere. Really, really quick overarching description of that. Get into the nuances of the policy, but what the CARES Act did was it retroactively eliminated that loss disallowance, if it will, or that loss limitation. So again, if you incurred losses in 2018 or 2019, you might be able to get a refund today for those losses without regard to 2020 or your pandemic, whether you're up, down, whether you've received federal assistance or not. So those are the major individual income tax changes in the CARES Act. Here are some numbers from, I believe, the Department of Revenue that have been offered, looking at the economic impact, the tax revenue impact of those provisions in isolation, and these will add up roughly to the $250 million figure that you've seen. So the changes to the charitable contribution, the addition of the above the line deduction is like a revenue loss of $6 million. The other changes is about $3 million. And this groups the 3 years together just for simplicity. The student loan provision is like $600,000. You can kind of get a sense for the scale here. The retirement fund rules, actually allowing people to withdraw money for COVID-related reasons. will actually increase Nebraska's tax because people are withdrawing money. So this shows you that some of this is, net increase to Nebraska, and some provisions are losses. Those RMD rules, the required minimum distributions, because we're going to allow people to not take distributions. That means their income will not go up. So that's a $13 million Nebraska tax loss estimate from the department. The NOL numbers are kind of grouped with the corporate, so I'll talk about those later. And then the excess business loss expansion. This number should just fly off the screen for you. $187 million aggregate loss over the 3 years. That's a biggie, right? If you're talking about a total of $250 million, this number just, as I said, flies off the screen. I should say at this point too that I am not an economist. Knowing whether these numbers are good, bad, indifferent is well outside of my area of expertise. I'm not an economist. I'm not a revenue estimator. So I, like others, have to take these numbers at face value. I don't have any reason to disbelieve them. I haven't seen any challenges to them. But just to the extent that there are questions about the magnitude of these, that's something I will just say I don't have expertise on. So taking these numbers at their face, right? The big one is that excess business loss expansion. So I'll talk a little bit now about what that means and who that benefits. So the excess business loss provisions, as I mentioned earlier, this was added in the Tax Cuts and Jobs Act, just a new section that said taxpayers are limited in their excess business losses. What it works out to mean is that taxpayers can't deduct more than $500,000. And that's married filing jointly. If you're a single individual, it's half of that. But $500,000 inflation adjusted, so it's a little bit more of today's dollars. You can't take more than $500,000 of losses from your pass-through business, your LLC, your S-Corp, sole proprietorship. You can't use more than $500,000 of that to offset your other income. Right? We're just going to cap you. You can do your investments in your businesses however you want, run your pass-through business. You can use losses in that business to offset your income from that business, and you don't have to pay tax on it. What Congress said, though, is we don't want you then using those losses from those businesses to offset other income, maybe your wage income. So maybe you've got $800,000 of wage income, and you've got $2 million of business loss for whatever reason. You can only offset up to that $500,000 of your income. Kind of a lesser focused on provision in the Tax Cuts and Jobs Act, enacted in conjunction with if you're familiar with the 199A pass-through deduction. Congress gave what's affect these pass-through business owners the ability to just deduct or not pay tax on 20% of their pass-through income. This one goes the other way. It says if you have a lot of losses, we don't want you washing out all of your other income with this. Also is enacted in conjunction with full expensing, if you're familiar with that part, where we would allow you to borrow $2 million, buy a piece of machinery, and immediately write that $2 million off. That would be a loss, right? And so this provision, it's a little bit goofy, but it prevents massive amounts of losses being used in this way. Now, needless to say, this type of provision, you have to be at a really high income level to be impacted, right? If you have income less than $500,000 of other income, not from your pass-through business, you can use these business losses to offset all this. So we're really talking about a provision that impacted people with this other income of over $500,000 a year. The other, so what the CARES Act did, I guess, is to just suspend that rule. And it suspended it retroactively to 2018. So for example, a taxpayer who generated a profit this year, just for whatever reason, right? They've done fine in the pandemic, or they received PPP funding, they received other grants, right? Regardless of this year, let's say they had large losses in 2018 or 2019. They bought a big piece of machinery and fully wrote it off, something of that nature. They would get to apply this provision and get a big refund from Nebraska, from the Department of Revenue. And that's regardless of, again, their 2020 income or losses or whatever aid they got under the CARES Act. So this point gets to the fit between these tax provisions and providing stimulus funding to businesses in need. Again, individuals who receive this will benefit. It's a little bit of a tough argument to directly tie this to companies that were impacted by the pandemic because it is retroactive. It doesn't apply just to 2020 or pandemic losses. It would allow people who are doing just fine or whatnot. It just doesn't matter what happened in 2020. You're going to go back and in 2018 or 2019 and grab a refund based upon those year losses. So the reason to focus in on this one specifically is obviously that big number. That's $187 million under the Department of Revenue's estimates. It's coming from individual taxpayers, and it's coming from individual taxpayers who, to be impacted, you have to be over the $500,000 level of income, of other income that you would have been prohibited. So there are distributional aspects to that, and there are some fit aspects to that. Save a little bit of that. If there are more questions on these individual provisions, happy to answer them, but also want to get through to some of these corporate provisions as well. So the corporate income tax provisions, there were also a number of these, kind of a wide range. There was a refundable employee retention credit. So there's this credit mechanism. There's the PPP loan forgiveness provisions. This has gotten a lot of press. It actually gets really complicated at the state level. Under current law, this is kind of a wash in Nebraska. It's something to watch out for in the future, though. There were modified NOL rules at the corporate level as well. So Congress, there was an 80% limit on those NOLs. You can take your losses forward, but we don't want you washing out 100% of your income next year with those NOLs. They capped it under the Tax Cut Jobs Act. Under the CARES Act, they just let that go again, right? Get rid of that cap. There's some increase to the charitable deductions at the corporate level, some tweaks to those rules as well to be a little bit more liberal in how we're going to allow deductions for charitable activities or charitable giving. Then the last two are some kind of tax policy wonky ones. The Tax Cuts and Jobs Act put a limit on the amount of interest that certain businesses could deduct. Small businesses were exempted, so this was a kind of a big business issue. You couldn't deduct interest that exceeded 30% of this adjusted taxable income number. Kind of a weird figure in the tax community, trying to figure out who is actually impacted by this. But the CARES Act liberalized that rule, and it said, well, we're not going to use 30%. We'll allow you to deduct interest up to 50% of your adjusted taxable income. Again, small business exception here. So the actual impact of that one's a little bit more difficult to see. But the CARES Act did liberalize that and allow taxpayers to deduct more interest than they otherwise would have been able to under the Tax Cuts and Jobs Act. Again, not tied to interest incurred because of the pandemic, another kind of fit issue, but it would apply to certain large companies who would exceed these levels. And then it retroactively expanded full expensing. If you recall, under the Tax Cut Jobs Act, one of the major policy changes was to allow companies to immediately deduct the entire cost of a lot of their capital investments. A lot of debate, economic debate and tax policy debate around that provision. What the CARES Act did is there's actually a glitch, and Congress inadvertently left the class of assets out of that full expensing, and the CARES Act fixes it, and it just includes those, but it includes them retroactively. So it would be a tax loss. It's cleanup for the Tax Cuts Jobs Act in that way. So as far as revenue, then I'll move on here. The employer retention credit's actually a tax increase as estimated by the Department of Revenue. PPP loan forgiveness is a big question mark. As I said, it gets complicated at the state level. It's changing, and there are murmurs federally, and that could have a bigger impact on Nebraska if there were changes. The modified corporate NOL rules is about an $18 million loss. The charitable deduction change is about a $4 million, and that interest deduction changes again about an $18 million loss. Didn't see a number on full expensing. That's a little bit maybe more challenging. It's a pretty targeted additional provision. What you see immediately from these numbers, at least what stands out to me is, not the economist, whatnot, is these numbers are obviously a lot smaller than the individual changes, that excess business loss provision, but these numbers are still really big. $18 million is a lot of pencils or a lot of whatever it is that you're going to spend state or local money on. So it's with this context we think about the question of whether these are the types of reforms that we want to enact and whether these tax cuts provide that stimulus, and are these the way to do it. So I'll leave the technical tax side here. I'm happy to answer questions on those individual provisions, but don't want to turn this into tax class if we don't need to, and move on to just some more general data. This is a map from the National Conference on State Legislators, just showing you state legislative sessions. I think it was updated as of even maybe yesterday. So one of the questions that the legislature will face is, well, what are other states doing, right? Are we going to be an outlier? What's going on? I've seen some suggestion in the writings that, oh, states are largely abiding by the CARES Act. They're not decoupling. And what this map really shows you is only the states in green are currently in session, at least according to the NCSL's data. States are doing a lot of oddball things and having sessions pop up, but this is the best data that I could get from the NCSL. So it's only those states in green that are actively in session. You see Nebraska there as suspended, postponed, so we'll be popping back up here. So the question is, of those states, right, are they able to act? How have states been able to respond to this? So what we see is, of the states that are currently in session, only Delaware and New York and Rhode Island are like Nebraska, rolling states, where these changes will automatically impact their laws. New York almost immediately opted out. They enacted a provision that said, you know what, we're normally a rolling conformity state. What we're going to do is adopt fixed conformity to the tax code as it existed, I think, the day before the CARES Act. And until sometime in the future, that's what we're going to do. We, the state legislature, are going to decide what our tax laws are and what changes we want to make from there. Rhode Island, I looked a little bit into this. I haven't seen specific action in Rhode Island. I did see an estimate that their revenue estimators made, that it's a $17.5 million issue over 2 years. I don't know enough about Rhode Island politics or economics to know whether that's a meaningful number or how things are progressing there. But it's it's much smaller than what we're facing in Nebraska. So the fact that they have not passed something yet, I don't know what to make of that. But it's fair to say that right now Rhode Island is also thinking about the issue, and there are discussions. Delaware, I wasn't able to find much good information. Delaware relies really heavily, obviously, on business registrations and things of that nature. So Delaware is always a hard state to gauge how states are acting. Another major state here is Colorado, which is also a rolling conformity state. Just in June, they did pass a decoupling bill. So they had a session that ended, and they passed a bill to decouple, said we can't afford this. The bill also included other tax reform measures, and that's had some political anxiety around it. And the governor, last information I've seen is that the governor is still sitting on that bill and trying to figure out what to do with it. I think there were threats of a veto as the bill was being debated. Again, I'm not an expert on Colorado politics. I know that bill is much broader than just CARES Act decoupling, so whether and how that's incorporated. But what we do see is a rolling conformity state that said, we can't afford this, we're going to opt out. Of the static states, which we would be, of the green states on the map, every state other than the one that I mentioned, so California, Hawaii, North Carolina, Ohio, all of those other states, static conformity states, I am not aware of any static conformity state in the country that has updated their date to incorporate the CARES Act changes. The two states that have updated their conformity dates have affirmatively decoupled and said, we can't afford it, right? We need to make the call. So Georgia and North Carolina updated their conformity dates. They conform to the tax code after the CARES Act, but they explicitly say, but not this, but not this, but not this. So they have decoupled. Other static conformity states are rolling along with their pre-CARES Act provisions, and they have not affirmatively elected into those. So it shows you a little bit of the difference in dynamic between rolling conformity states and static conformity states. Static conformity states are in the driver's seat. rolling conformity states have to respond. And none of those static conformity states that I know of have said, yeah, we want to provide this as well. And the two that have looked at it have opted out. So that's a little bit of the lay of the land of other states if you're interested in how states are going to handle this. We'll see a lot more activity on this, obviously, as we roll forward into the next year as these state legislative sessions ramp up again in 2021, which is a crazy year to be thinking about. Okay, so I will end. I want to leave plenty of time for questions, so just end on my recommendations. Some of this comes through my experience and my insights and the reading and work that I've done on this, and some is obviously personal intuition, so take it for what you will. I think, and what I've published and what I've written with others, and this is not just Nebraska, this is nationwide, is that states should decouple from these changes and maintain the status quo. States don't have borrowing capacity like the federal government. States generally aren't in a position to provide stimulus funding. State revenues are down, people are struggling, states are funding critical public services. We have to rely on the federal government for stimulus-based funding. They can borrow, they can handle it. To take money for stimulus at a state level, again, you're giving to Group A, it's gotta come from a Group B. It can't come from borrowing. It can't come from the same set of tools that Congress has. So I and others have just broadly recommended decouple, maintain the status quo, and then take a look at these provisions and see what makes sense. What's notable is that the state does, it's not all or nothing. I've seen some suggestions in what's been written across the state that, oh, we need to keep this or we need to keep this. Decoupling doesn't mean you reject everything. If the state wanted, it could take pieces, right? It could say, you know what, that charitable contribution, that $6 million, we can take that hit, right? The state could do that, decouple from all of the changes but this, or it could just say, we only want to accept X, Y, and Z. That comes down to legislative judgment and a determination, right? Which changes make sense for Nebraska and on our own schedule, right? We have to make tax policy. We have to make fiscal decisions for us. Decoupling allows Nebraska to do that, and with a greater knowledge of our need. If the legislature were to decouple and then consider this later, right, we'll have a better idea of which businesses are hurting. Is there more federal assistance, right? There are ongoing discussions about Congress providing more funding to the states, more grants, more taxpayer relief. In the midst of that, at least in my mind, it's very difficult for the state to come out of its own pocket, right, that $250 million without knowing where it's going to be. So the recommendation broadly is to decouple, take stock there, take a look at what provisions actually make sense for Nebraska. And if some of them do, adopt those piecemeal, totally fine, but recognize the trade-off that you're making. So the response, of course, what about the need? Are you denying tax relief to individuals? That's a really hard frame. And unfortunately, that's the frame that we get put in when we adopt rolling conformity. It should ring a little bit familiar to people who were around with the Tax Cuts and Jobs Act. If you remember, the discussion there was those federal changes were going to cause an increase to Nebraska taxes, right? There was this big windfall, right? There, legislature acted, decoupled, made changes to Nebraska law to make sure that we didn't have that windfall on the upside. So how do you respond now? Decoupling, you're going to deny taxpayers these tax breaks. I think that's absolutely right, right? There's no doubt that if you decouple, those businesses who would benefit will not get the benefit, right? It is also true that those taxpayers still get the federal benefit. We're only talking about the Nebraska 7 cents on a dollar or less of tax benefits. So those taxpayers are getting the federal tax break, right? That 35 cents on the dollar or whatever it happens to be. There's also the CARES Act, right? The $8 billion of funding. Here we're talking about $250 million, $187 million of which goes to individuals with those incomes over $500,000 a year. So for those with need, this tax cut, potential tax cut of $250 million, in my mind, has to be viewed in the context of $8 billion of other funding, and $8 billion of funding that was directly targeted at businesses and individuals in need, right? We all got the EIP payments, except at really high income levels. And the PPP program was wildly successful for Nebraska businesses. So if there is a Nebraska need, right, this is the role of the federal government, right? This is what those federal programs have done. There's $8 billion that have come in. And at the end of the day, you have to make this trade-off analysis, right? If you provide those non-targeted tax cuts, if you say, yes, this is a community in need, maybe the CARES Act changes aren't targeted enough, but we want to get them money. The next question has to be, who pays, right? Does that come out of reduced spending? Does that come out of property tax relief? Does that come out of increased taxes elsewhere? We don't have the same option at the federal government that the federal government has to just borrow the money. So if you're focused on those in need, if you're focused on who the CARES Act would benefit and who decoupling would reduce that benefit, the next question has to be, where is it going to come from? So it's for all of those reasons that I and others, as we've written, and I'm happy, I know Renee has links to the stuff, just broadly recommend that states take control, decouple, and then just kind of take a breath and figure out where you are. So that's what I've got. Big picture, really big overview. Apologize for how long it is. As you can see, this is a really complicated topic with a lot of interrelated pieces. Hopefully that provides you a little bit of an introduction, and I'm happy to answer questions as they come up.
Great, that was excellent. Thank you so much for that overview. I thought you provided a lot of really helpful information. So a few questions, we have several questions for you. One that came in from a senator early on, which I think you answered, but I think it's worth just making sure that, that everyone understands. And that question was, okay, how the Pre-CARES Act law had NOL provisions. How did the CARES Act change those provisions?
Yeah, so in a couple of different ways, and the impact in Nebraska is different whether it's an individual taxpayer or a corporate taxpayer. So under the Tax Cuts and Jobs Act, this is complicated because there's a lot of changes here recently. Under the Tax Cuts and Jobs Act, taxpayers were only allowed to carry their net operating losses forward, but forward forever, and subject to that 80% limitation. You couldn't offset more than 80% of your income. What the CARES Act did is said, we can go back 5 years, right? We're gonna give retroactive relief. It allowed that retroactively, so 2018, 2019, you can carry those losses back in this 5-year window, and you can go forward then, and you don't have that 80% limit. Now, that impacts Nebraska individuals because for individuals, Nebraska follows that. Nebraska for corporations, we only allow a carry forward. So on the corporate side, the change is really just that 80% limit. And so under the CARES Act, you could offset up to 100% of your income with those NOLs rather than just that 80% as under the TCJA. Really complicated, but hopefully that again, the Department of Revenue document does a pretty nice job of spelling this out as well if you're more of a text learner than audio.
Great, thank you so much. We also had a question which you answered at the end, and I don't know if you want to say anything else about this, but there was a question about, you know, what is the precedent in the state for decoupling from tax changes made at the state level? Yeah,
so I don't have an overarching list. I think the quickest way to see it is to pull up the Nebraska tax return. You see, you start with federal income, and then there's a whole host of adjustments that Nebraska requires you to make. Each one of those is a situation in which the legislature has done something different than federal law. And so you have a whole schedule of things. The other major way, one of the comments that I've seen is, well, if we decouple, we're going to create more confusion and mess, and taxpayers are going to have to figure out how to report things differently. That's true. I'd also say the mess exists. the state of the world is not the ideal that a lot of tax people would like, where every state is consistent. States are already wildly inconsistent from one another, and reporting at the federal level and the state level differs in a variety of ways. Yes, decoupling. So decoupling, we've done it. We do it often. There were changes made after the Tax Cuts and Jobs Act. But also, conformity doesn't mean it's simple for taxpayers. There's a wide range of ways in which they already have to make changes, both from other states and federally. And we've already seen states decoupling from the CARES Act. So multi-state taxpayers especially, they're going to be in this complication regardless of what Nebraska does. I know that's a really quick overview, but without getting into all the details, I'd recommend looking at the Nebraska tax return instead of digging into the statutes. Look at that long list of additions and subtractions that taxpayers have to make. Each one of those is an instance where Nebraska has done something different than the federal government.
Great, that's really helpful. Do you know what category or size of businesses benefit most from these tax changes?
You know, to some extent, no, because they're broad. And that's one of the issues that I personally have with using this as stimulus, is it's not really targeted. We can't say who this is going to benefit. A number of them, though, we know are just really large companies. So the net interest limitation, there's a small business exception that I think is something like 25 million. I might have a decimal. It's a large number that you're just excluded from having. So that provision is aimed at large businesses. The excess business loss provision, right? The cap is at $500,000. So to be impacted, you have to have over $500,000 of income. So the type of business, the industry, given the non-targeted nature of these tax cuts, it's hard to hone in on anything. It is easy to see how some of them are available and really only impact large businesses, lots of revenue, or individual taxpayers with a significant amount of ordinary income or other income.
And I think one thing that I would lift up in contrast a little bit, you mentioned the PPP loans. And obviously there was also the CARES Act funding and the Coronavirus Relief Fund that came into the state, and 330 million of that went to businesses. And my understanding is of that 330 million, those businesses did have to show a revenue loss. So there has been, to your point about the federal government is in a better position, but there have also been decisions made at the state level, and the executive branch has decided to use a good chunk of the funding that's coming through the Coronavirus Relief Fund to support businesses who have suffered losses in 2020, right? So
I think that's right. And that's a good example of kind of how this should work, right? The federal government provides the money. Right? The federal government has the ability to borrow. It has the national economy and national credit behind it. States don't, right? We have a balanced budget amendment, and we're not in a good position to do that just generally. So the federal government provided those funds. And then, as you've seen in the press and whatnot, the governor has been able to direct those funds to businesses in need who have shown specific needs. Again, I'm not an expert on those funds, but I think you're absolutely right that hundreds of millions of dollars of funding has been made available from the federal government. It doesn't have to come from Nebraskans, right? We don't have to choose. That's money that's been directly provided to us that we can specifically target to the businesses in need. And I think there are efforts along to try to get more of that, right? There's a big push. The federal response, as big as it was not enough to help out the states. States are struggling, and there's an ongoing push to get states more of that type of assistance because of the broad recognition that the federal government has the ability, and states just don't.
Let me ask you a timing question. If the legislature didn't take action, did not decouple during the remaining 17-day legislative session, could they decouple in the 2021 session?
Yeah, so the legislature could do it. The challenge, of course, is that you would be doing so retroactively at this point, right? People have already been granted this relief. It is currently Nebraska law. And so it put the legislature in a little bit of a tricky position, I would imagine. Again, I'm not a politician, I'm not a legislative guy, but as a matter of law, they could go in and retroactively change this and say, we're not going to do it. That might require the department to go back and claw back some money, or the framing's a little bit different, right? It's tougher to make changes backwards when you're reducing these sorts of things, but they could. It's just a little bit challenging, right? It puts them in a different position of having to take away something after another 6 months have passed and after people have reacted. And
the flip side, if they opted to decouple, could they come back and couple later? Let's say it turns out that we're in much better revenue shape. We don't have a shortfall. We have a surplus and we wanted to use the surplus. Is that another way of thinking about it?
Yeah, I mean, again, subject to the political process, but, as a matter of tax law, I mean, that would be and that's kind of what I've suggested, right? And again, this is not me talking to Nebraska as a Nebraska voter. This is my position as a scholar and somebody who studied this and talking to states across the country. The better position is to do that, to decouple, take control, right? Take control of your own finances and breathe, right? This is a challenging time. And then if you feel like you can do it, if you feel like these are appropriate responses, you can come in and enact it, right? There's nothing to prevent you from doing that with a better grip on your finances, right? It's a very conservative move to make, right? See how things work out. And you've got this package there and you can say, all right, things ended up fine. Let's enact it now. It's already retroactive. So let's just follow along, make it retroactive and go forward from there.
Great. You mentioned this, but I want to just bring it up again. You highlighted that one number that was jumping off the screen, the 187 million. And so lawmakers could opt to decouple from just one. They don't have to decouple from everything, right? They could pick and choose.
Right. And I think that's a really key part, because the politics on these individual provisions can be different. The numbers are just different. It might not be worth fighting over the $600,000 for one provision. This is just a matter of the legislature making a choice and drafting the rule that they want. So if they just want to decouple from the excess business loss provision, just draft it up. That's what we do. They have that flexibility. They're absolutely not tied to all or nothing. And so I think it's important to keep that in mind, because some of the framing that I've seen is like, oh, look at all of the things that we would lose if we decoupled. That's just a false frame. The legislature has the authority. All that we've done is delegated the first order decision making to Congress. We retain the ability to pick and choose and do whatever we want. We just have to do it. Right? We've just put ourselves in the position of having to act because we wanted to delegate earlier.
And I think you mentioned too, there is one group of taxpayers that would pay more if we didn't decouple, right? I remember there are a
couple of revenue increases in there, absolutely. And so, it's a mixed bag, and you got to figure out how you want to deal with those individual things. But again, it's a matter of how much autonomy the legislature wants to take and how much control it wants to take over its own budget, and taking a look. And that's tough, right? It takes legislative time and attention. And maybe that makes a heck of a lot more sense when the number is 187 million than when it's 600,000. But those are the kinds of decisions the legislature can make, right? We are not stuck with this just because Congress said so. We've just put ourselves in a position that if we want to control our own destiny, we have to.
That's great. And I think that's a really great summary. And of course, our phone is ringing. So nothing like a Zoom meeting with some interruptions. So with that, thanks so much for joining us today. Thank you, Professor Thimmesch. We'll have all this available to you later. And thanks for joining us today. Take care.
Thanks for having me.